Okay, very good morning and a happy Valentine's Day to all. 14th of February. Getting straight into the briefing then, what we're going to talk about is there's not a great deal of fresh real news to look at because everyone is looking forward to, of course, US inflation data coming out later this afternoon at 1:30. So in terms of this briefing, I'm going to focus really on that, and then I'll hand you over to Sam. He's going to look at some of the charts as well. So usual kind of setup. In terms of the charts this morning, just before I get into the inflation outlook for today, you've got US and European stock indices already on the front foot. Just as I really sat down this morning as UK and Europe came in, just saw US index futures have a little squeeze higher. Nothing new that's occurred other than technically just getting our heads above the levels we printed back at the beginning of the week on Monday. And you can see that breach there just contributing to futures having a bit of an extended run up to R1. This is the S&P I'm looking at. And then we're finding some support around the previous resistance point which we broke earlier on, which was the Monday high. Just having a quick look in a longer time frame. And this obviously tells a much bigger story because this is telling the story of the big shakeout that we had commencing on the Friday of payrolls, initiated of course by that wage print which ignited this fear of inflation rising and its policy response of tightening that might occur on the back of that. And then obviously Monday was the big sell-off. So this is where we are in the grander scheme of things, and we've recovered, as you can see, pretty much 3/4 of the entire downtick that was seen on that Monday session. And this really sets us up quite nicely for today, which is going to be the next meaningful kind of pivot point, if you like, of where do we go from here. Was the market right to panic so much on that Monday last week? Or were we all kind of getting a little bit too excited at that point in time? And although inflation is going to rise, it's going to be a sequence of several months before we start to see it meaningfully rise to the point of which is going to start to alter policy going forward from a, let's say, number of rate hike point of view. So equities on the front foot this morning. Yeah, not really too much in the way of fresh news to underpin that. I'd say more just a little bit of a technical breach this morning. So hence you're seeing maybe a little bit of profit taking on that initial blip high that we had just as we came into the market. Elsewhere in fixed income, bunds up as well at the moment. T-notes up about 3 ticks. The currency pairs, the dollar's a little bit weaker again, down about just shy of 0.2. So both major pairs elevated, albeit off their best levels that were seen overnight in the Asia Pac session. So not really a great deal to go on in terms of an overall theme this morning. And I'd say, again, the majority of market participants are going to be very much just sitting on their hands and just awaiting that of the data at 1:30. So what is it that we're looking for from the data? Let's just get down to the detail. And I thought this was quite funny this morning. This is Bloomberg saying US inflation has Asian traders staying up with pizza and Coke. And that's not Coke as in the naughty stuff, that's Diet Coke as in the liquid stuff. And what we have here is the point they're making is that a lot of people want to stay up and watch this particular event. Now, this actually then does start to, if you think about this as a behavioral point of view, it means that there's going to be a lot of people putting a lot riding on one piece of economic data. So typically what tends to happen is that saps all of the market's attention and then equally its liquidity to then one big flash moment of when that gets released. And then all of a sudden you have this massive flux of volatility that then follows. So one thing is that headlines like this do actually frighten me slightly, because this means then that if everyone looks at one singular event so intently, then it does tend to create quite a wild degree of volatility upon its release. Now, we're going to break it down as to how assets might react, but certainly it's just interesting about how much now, given the context of what initiated the sell-off originally on the kind of crash that we had last Monday, that the importance value of this has gone up exponentially. What are we looking at then? Well, the main event is the CPI, and looking at the year-on-year from the US and the core year-on-year. Now, one thing, first of all, to note is that we're looking for a 0.1% decrease from the previous month. So the year-on-year, in fact, is anticipated to fall to 2% and the core to 1.7. Now, like with any economic data, you've got to know your ranges, because then only then can you determine whether or not this is really outside of the parameters of which what the market was expecting. So for the year-on-year, you've got a low at 1.9, a high of 2.3. That's actually pretty toppy on the high ends. Someone looking for a pretty elevated number. Don't forget the consensus is for 2, and for a CPI kind of year-to-year movement, i.e. month-to-month release of this data set, usual increments tend to be around 0.1 or 0.3 away from consensus would be a really big surprise. The core reading, the range is 1.6 to 1.8. Now, what does that look like from a core perspective? Well, the top end of the range, well, what's expected is for a move back to what has been really the average of the last several months, which is 1.7. The upside top end estimate is 1.8. So if we did, let's say, break the upper bound of what the market is expecting and print at 1.9, that would be a massive surprise. If that year-on-year as well came in at the top end of around 2.3% of analyst ranges, that's then what's probably going to continue to see a reinitiation of what occurred on the previous Monday. That being then that these fears of heightening inflation have become a distinct reality. Equities would sell off aggressively, yields would spike, and then you'd see this play out across a repeat of what we had on that kind of fateful evening in Wall Street trade, where the Dow just absolutely dropped like a stone. So this would all come if we had surprisingly strong inflation. Now, a couple things though. I have read this FT article this morning, which is really quite excellent because it outlines some really key things to be aware of. And it talks about US inflation and the 5 things to watch. So let me just go through and highlight a couple of different factors to be aware of. First thing is the Forex consideration. And by that what I mean is the movement of the dollar over the period of which this month is a survey of, which is January. So exchange rates between the US dollar and the currencies of America's trading partners might have played a part in the release today. Trade-weighted dollar, which obviously affects the inflation through import prices, has declined by about 10% in January from the year before. Notable then because the dollar rally helped keep inflation low in 2015. So have the dollar's persistent weakness that we've been seeing start to translate into these inflationary prices. There is something called as well separately the Verizon effect, which you might have read about. Short-term price pressures could cause CPI to fall short, i.e. come in lower than expected. A culprit might be wireless telephone services category. So when you start breaking down what is CPI, well, it's a measurement of a basket of lots and lots of different goods which can be put into subsections. One of those subsections which has been particularly prevalent of late is the wireless telephone services category. Why is that? Well, cell phone services costs make up about 1.7% of the overall consumer price index, which is notable because this is this phenomenon what's termed as the Verizon effect. So what this is in early last year, Verizon decided to offer its wireless customers unlimited data at a flat rate. So Wednesday, i.e. today's CPI report, should be one of the final reports to reflect the substantial drop in wireless data prices compared to the year before, which is what the Fed, if you remember in their language, have said and used to explain why inflation has been artificially low at the moment, and their expectation is it will rise thereafter. The question is, how much of a lingering effect does this year-on-year Verizon effect have on today's number? I.e., does that mean it's going to weigh it down? But net, in a few months' time, it is going to pick up as that washes out of the system, so to speak. The other thing to be aware of is methodology change from the Bureau of Labour Statistics, who compile this data. So for January's data, the BLS have modified the methodology for CPI in 3 different ways. First, it will make changes to its geographical sample. Second, it will start adjusting its smartphone price measurements to account for changes in the quality of hardware. And finally, it will switch the way it includes used car prices in the index. So what does methodology tend to equal in terms of measurement of statistical data? It tends to then create noise, i.e. Some subtle changes in the way that the whole overall sample is collected and calculated means that you tend to get deviations in the data set. This then could cause a number to come in high or low, which causes an immediate amount of, let's say, fluctuation in market prices and activity, only then to be counteracted by the fact that people discount the number because of the methodology change. So if you start stacking all this up, the Verizon effect, the Forex effect, the methodology change, the fact that everyone is so focused on this, they had a Bank of America fund manager survey released earlier this week, and it said that fund managers globally named inflation-fueled bond market sell-off as the top risk to markets in a survey last week. This being then this trigger point that faster than expected wage growth is going to start culminating into increasing fears over inflation going forward. So there's a lot to the inflation data coming out later today, and what I feel as though is that this is going to create a wild amount of initial volatility. And the important thing to recognize here is that this data is important, and that doesn't mean then that you have to hit the data at its first glance. What I'm suggesting by the things I've just gone over, that's going to be incredibly difficult to try and hit market very early on the release, because there's a degree of noise surrounding these underlying calculations of the numbers and its seasonality and so on. So the trade could obviously come half an hour later. If you think about what it is that really initiated the snowball effect of the market sell-off a week ago, it was the equity market. So might the prudent strategy be to wait until the Wall Street Open an hour after this data comes out for the market to rationally make a decision about what does this inflation number and report that we've seen really mean for inflation expectations going forward and our expectations about the response of central banks. Then you might start to see a more meaningful and cleaner move once Wall Street trade gets underway. So I don't think you really need to rush it, is the point going forward. So quite a few things there to digest and just be aware of. I'll leave Sam to come on and possibly look at some of the charts, but I'd say one thing is that because of the overhypedness of today's figure, and because of the fact that everyone seems to be excited about inflation, I actually think if you get an inline reading today, this could be one scenario. If you get an inline reading today, which normally of course would be a net neutral, I think the market is almost positioned itself mentally for higher numbers. And so if we get an inline reading, is that deemed as being low? And in that sense then, do equities start to rally again? Because of the fact that, you know, maybe we got a little ahead of ourselves by the moves that occurred a week ago. So again, in its most binary sense, if we had a low inflation numbers today, typically this would then lead to an extension of dollar selling. It means then that equities would probably rally, we get a reversal, yields fall, so bonds start rallying in that sense. One of the interesting things that I heard a market pundit talk about this morning is treasuries or T-notes and how fixed income will react, because if you get a low inflation number, people start unwinding this immediate inflation fear, yields fall, bond prices rally. If you get a really high inflation number, equities really spike lower, and then you get a flight to quality and treasuries rally. So either way, there's an argument for them being supported. So you know, it's definitely going to be interesting when this comes out later. More on it before it comes out. One of the other things quickly, just to cover, you did have Japanese growth data overnight. Japanese GDP did come in weaker than expected. Now, I do expect dollar yen to be an asset that a lot of traders will be watching today, especially around the dollar movement and the movement that could be inspired on the back of this US data at 1:30. And the reason why is because dollar yen has traded at a really interesting level. This is a daily continuation chart of dollar yen, and we've already broken, you can see that quite key technical level of the 8th of September of 107.27. You can see where this played out, and the reason for its significance. It was also a key level of resistance as well on the summer of 2016, and we've broke below there, and at the moment trade just sub that level around the 107 handle. So quite interesting then. This is what it looks like on a daily continuation. If you put it onto a shorter time frame, this was that level. You can see it testing yesterday through a number of occasions, and it holding up, but then eventually, as soon as Asia came into the market, that GDP disappointed. That meant that then it's almost the reverse effect, if you like, that prompted some risk off trade overnight, and the yen actually strengthening and breaching lower. And then you can see you had quite a decent run before we've recovered here and found some resistance to the previous level of support on that key 107.27 mark. So dollar yen a consideration for any FX traders today. And then finally, just before we have a look at the calendar, other than CPI, we did have the API crude oil inventory numbers last night. So we actually had a slight dip in prices. So just to refresh you, the crude number was a build of 3.947 million, slightly higher than expected, but the Cushing number, the gasoline number came in at 4.634 million. So although the Cushing negates it slightly, because this is obviously a bullish number, overall the market took a bit of a bearish spin to the data set as an overall assessment. Crude, slightly bigger build, gasoline fairly large as well. So again, you've got your DOEs later. And in terms of the shape of the calendar, really this morning, I think just keep things in relative check. Even around the GDP European data, I would definitely keep an eye on that. But if you are going to trade it, I'd probably advise keeping the size relatively small, because the real action today is going to come in the afternoon. That's where you want to allocate your attention, and you want to have plenty of ammunition ready and armed for later on this afternoon. If this data is out of line, you can expect us, the likelihood of probably it's going to be the most volatile it's been since last week. Alongside the CPI report though, don't forget you do also have US retail sales. Now, in terms of how do you kind of go into a situation where you've got two traditionally kind of tier 1 data releases? Well, this is all about a hierarchy of events, and on a normal basis, I would say CPI, given the fact that this is such a focus for Federal Reserve policymakers, I'd probably weight this 75-25 in terms of consideration of market reaction to these data sets. Today specifically though, I think that goes out the perspective a little bit because of the overall market focus given the context of the prior week. I think this is now a 90-10 in terms of how the market's going to focus on this data. By that I mean 90% of the market's reaction is going to be coming from the CPI data, and only a more, or a less, I should say, smaller degree of focus on the retail sale report. Then you've got the crude oil inventories in the afternoon. Speaker-wise, that's the one thing to look out for, I guess, from the morning. Weidmann, as far as I'm aware, nothing really new has been said, but you've got Mersch later on. All right, let me hand you over to Sam, say a few words, but wish you all a good day. Thank you.
And good morning, guys. We'll start off with the currencies before heading over to US equities, which just, I'm sure you're all aware, just around their R1 levels in the futures for both Dow, Nasdaq and S&P. Starting off with the pound, it was quite a choppy day if you look at it yesterday. A couple of half decent opportunities where we did eventually break lower. You can see here it doesn't look that clear, but there was a couple of decent moves yesterday. I think today, as Ant has mentioned, it's not one where you're going to want to get involved too heavily in the morning or before 1:30, more specifically. So it would be wise to sort of hold out. I think we'll run through this before the actual release, but something like this, it's always just key to before the day even starts, just mark up all the key sort of previous turning points, i.e. support and resistance levels that they've been today, where you could perhaps see a reaction later on, and by just doing that you can see there's quite a few that are drawn up previous points below where we're trading, where the buyers have taken over and sellers above, and that's not even having any trend lines on or anything. So it's been quite choppy, I would say, well, last few weeks anyway for FX pairs. If we have a quick, if I just make this a bit smaller, the picture or the candles, as to say, I would definitely be looking to have some sort of trend line going on from the lows we had last week, just up here. Potential point in the market, beforehand, that interests me quite a bit. You can see where was the low, the back end of yesterday's trading session. If it sort of lines up along here later on in the day, potential for a good sort of technical trade back up towards the pivot. To the upside, obviously the higher the day and higher of yesterday are barriers at the moment. I mean, the pivot for me has already been cut up and an area probably best left alone as it stands. Of course, if the date comes out and you are looking for an entry or target, then you could consider it, but right now it's been sort of tested, I would say, too many times. Euro, if we have a look just below where we're trading now, I think we found a good area of support in that late session yesterday, which could offer, from a technical perspective, the move higher. We sort of broke this. Here we go. Let's get this on this trend line last night. So I'd be aware, if we do come back to test that later on, you've also got, previous support we had this morning near those lows of the day. So there's a couple of opportunities from a technical point of view, but of course, come 1:30, that could absolutely, change, in terms of the dollar. How to sort of view this market. Aussie dollar, let me just refresh this. Similar to the other two, in quite choppy for direction. You can see here, this is, well, going back what we got here, 5th of Feb, so 9 days later, still relatively near to where we were trading before. The pivot has offered good support, this whole area in general on the futures, that I would definitely be aware of. Going forward, we have broken, this low. So this was sort of offer the resistance to the move higher, but sorry, again, it'd be a case of probably just waiting it out. I think you may get a couple of moves, but in terms of anything long lasting before the main event, I'm not going to be expecting too much. Dollar yen yesterday making that 5-month low. We did have a little bounce higher yesterday before coming back down overnight. Just finding, it's not the most perfect trade, but where you can see this whole area which found support once, twice, 3 times, and then again early hours we've now just found a bit of resistance, perhaps looking for that move lower. Safer, you've got to say, is this whole previous, well, this is where we eventually made that move early on around 7-8, and the pivot looks a bit more well, probably unrealistic for now, but you never know, later on could offer a good resistance to sort of cap the move higher and then extend the moves that we've seen to make that 5-week low. Moving into equity, start with European. Let's have a look at the DAX, what it's doing at the moment. Understandably not too much for now, and again another market that has been quite choppy, deciding whether to go higher or lower. Into the end of the session yesterday, sort of recovering a bit, which sort of led over into the Asian session as well. I'll just mark up this range for the DAX. Obviously we know it's a pretty volatile product, and even more so with everything that's going on at the moment. I think if we do perhaps break higher, you can get that run to the highs we saw of Monday in the week. If we come back lower, then you're starting to get into this mess here. I think S1 yesterday was just such a tricky area where there wasn't really any clear direction. So I think if we were to come back down towards today's pivot, well, you've got to say first test, you'd expect some support. I think better left alone, really. I think there's going to be better opportunities for equity markets elsewhere. S&P, let's have a quick look. As mentioned, just near that R1, we'll have a quick flick over to the Nasdaq. There you go, R1, Dow Jones as well, just above, and that classic working quite well. So Dow Jones perhaps just sort of leading the way here, and I'd keep an eye on that previous high we made earlier this morning. If we can get a push above that, you know, you've got the highs that we saw on the 8th, which would be, what day of the week was the 8th? Thursday, yeah, last Thursday. And then we start, you know, thinking about, can we get into the levels we mentioned yesterday in the briefing and throughout, just above, you know, not a million miles away, well, this sort of area here for the Dow Jones, but Thursday's level not too far away to the upside. S&P is going to mark up that resistance that we were talking about for the Dow, using the lows before the big sell-off on that Monday, well, 2 Mondays ago, on the Friday. If we can push above this R1, you've got that level similar to the Dow just before R2, so we'd expect this to be quite a good resistance point here if we can push above all the respective resistance levels. Nasdaq, you can see similar. If we can push above the R1, and it's giving it a bit of a go at the moment, so I would bear that in mind. But again, with the main focus going to be elsewhere today, I think short-term profit targets would perhaps be a bit better. As mentioned as well by Ant 330, you've got the oil. I mean, that's a pretty clear trend if you're having a look at that from well, the beginning of Feb. So it would be something, you know, for those that like a trend line, just to see if you can get one on there. You know, it's been relatively respected for now. I think, you know, for perhaps a more medium-term trade, if we were to get up anywhere near here, the high that we saw Monday would be quite nice. Resistance 1 marks up quite well with yesterday's high. Let's get that area here. And as well, from the downside, if we were to see, you know, a move down from here, how could you look to enter? If we get that trend line from the low marked up yesterday, you know, ideally what you'd want to see from here is another, you know, it to be respected. You almost get that third test, push back higher, and then you get the break on through, and then you can then target the S1 and then the low of the week. That's sort of the way I would be looking at it. Let's just see if we can get another trend line on here. Perhaps, you know, another one there, just to see price getting squeezed in. You want to see that respected before perhaps looking later in the day. We'll wrap up here with gold just coming under a slight bit of pressure. The dollar has strengthened a tiny bit over the last hour, and with equities pushing higher, that's understandably just weighing on gold a tad there. Let me just, no, cancel. Let me just refresh the chart. There you go. Area support near that low. Couple of decent opportunities again in gold yesterday when we did break low, all at the same time the dollar strengthened. But as has been the case, even when the dollar has strengthened last couple of weeks, there's still been times when, you know, it's weakened across all currency pairs, and in gold it's similar as well. I think, you know, this is not a bad place to get in, but I just want to stress again, and sorry to bore you all, but it's going to be a case of sort of probably sitting on your hands until the afternoon, or perhaps looking at equities if you can get a real sort of push higher with momentum. Won't be expecting too much. We'll get on the mic again throughout the day, posting charts and ideas, and I hope everyone has done their research on the numbers, what to expect. But it's always a case with data. You know, we want to see a big outlier. That's going to be the easiest one to trade. But if I don't speak to you directly, hope you have a good day and good Valentine's Day as well.